All right, we're gonna do a three-way conversation today. I have Zed Francis from Convexitas and PJ Pierre from Denali. Right away, gentlemen, let's plug away at the top. Zed, we'll start with you. Where can the people find you?
Uh, Jason's made fun of me from past times for using, full, what do you even call it, address, but convexitas.com.
There
Right,
you
I'll
go.
leave the www out for you this time around. But yeah, convexitas.com, best way to see kind of what we're doing, writing about, talking about. Do a little bit of stuff on LinkedIn here or there, but yeah, that's the story.
PJ, where can everybody find you or not find you specifically is what you'd vote for.
Yeah, I'm probably not going to be that easy to find, but yeah, I mean PJ Pierre on LinkedIn and also on Twitter, but I don't really post that much, so that's at Tatiana Pierre at Twitter.
Well, this is my favorite part is like I think a good podcaster, if you're looking to maximize your podcast and get more eyeballs, is like you try to get people that are big on like Twitter or FinTwit or social media. So I was really smart in getting both of you that don't post to Twitter, don't even hang out there at all, and barely even lurk on Twitter. So that was really smart of me to really boost the ratings of the show. So I didn't we were joking about many things before we got on, but like I didn't have a general theme or practice other than I think both you guys understand credit and all those sorts of things a lot better than I do, so I just thought I'd get the three of us together. But maybe a jumping off point would be PJ. Recently I was just doing a podcast with Toby Carlisle, and you rightly called me out because unconsciously or flippantly I referenced fractional reserve banking, and so you texted me like you're an idiot, and so I appreciated that. But maybe
I, I
we
actually
could
said we can't be friends anymore.
That's right. So you were right in calling me out, and I will give the caveat though for any of you that want to get into podcasting or whatever. Just know if you podcast, you were going to say so many stupid things that even if you listen back, you'd argue with yourself because you got three things going on in your mind. So you say a lot of stupid things on autopilot. But that doesn't exonerate me. So first, let's correct me with fractional reserve banking is kind of a myth that gets perpetuated. So you could talk about price and equity and maybe give us a jumping off point there.
So is that me?
Yeah, you're the one that called me out. It's your turn.
Right. So well, you were sort of talking about the dynamics that took down SVB, I think. And I think you made an astute point that people don't really understand banking, and particularly people who are under the age of 40 who might have some, you know, misconceptions about banking. But, the dynamic of fractional reserve banking sort of is an anachronism from the fixed exchange gold standard days when we actually did have fractional reserve banking, and, all sorts of bank credits were, you know, horizontal endogenous money structures built on the vertical money, which would then be, gold bullion at the time. So, in this current iteration of modern banking, loans create deposits and by definition any required reserves. And I think I made the comment to you when we were going back and forth that it's always about price, not quantity on a floating FX system, which is sort of where the distinction actually becomes important.
So that's a good starting point. By the way, Zed, always feel free to jump in. You don't need to wait for me or anything. But so part of that though, when we were texting, I said, yeah, well, to initially start a bank, you have to put up equity, and so to me, that's a form of fractional reserve based on the equity, not on the reserve. So it's like fractional equity, right? You can only lend a certain amount of what you have in that equity. But
Absolutely.
maybe flesh out a little bit better. What do you mean by price?
Well, what I mean by price is that, bank lending isn't reserve constrained, whereas, so it's always just about the price of funding more than, it is sort of a stock of funds that you could then lend from. So anytime a bank could make a loan on favorable terms where the rate of return on the loan is going to be attractive enough for the risk, for the embedded risk that they model in the loan, on top of, whatever spread they want for their margin of error in their models, and the spread between their actual cost of funding the loan gets made. So it's in that situation, that's where like the monetarists, like in the 80s, sort of found that they really couldn't target the money aggregates that they wanted to, because by limiting the amount of reserves in the system didn't necessarily limit the amount of credit that was created. And it's just one of those situations where because that system is sort of an endogenous system, it doesn't really require anything external.
Zed, is there anything you disagree with what we said so far, or
No, I mean, like,
I
think no, I think more, in agreement, just adding on to it, that operating a bank is you're just trading a spread, right? So it's like,
Yes.
okay, we're gonna issue a loan with some sort of credit spread over what's determined to be risk-free rate, whether it's floating using Fed funds / SOFR, or whether it's a fixed thing that's priced off of treasuries. Okay, what's in that spread, and ultimately what's in like the credit spread portion, I would probably call like the piece of the loan where the bank's actually not really making a ton of money. Like they have a little bit of underwriting costs in there, they have credit risk of the institution, but that piece is kind of pretty efficient. And like, to be super boring, bank loans are a little bit more, we'll call it semi-private markets, not fully private, but semi-private markets versus listed fixed income instruments. But like, if you were to operate investment grade, long investment grade credit, completely interest rate hedge, historically, the 40 odd years of that indice, the excess return from owning credit versus just owning treasuries that was like key rate duration matched is essentially zero. So like in the publicly traded markets, you're like, I am taking on excess risk owning credit versus just treasuries, and my returns are kind of essentially excess returns. It's pretty similar for ag. You get a little bit better in high yield, but like ultimately the market's actually pretty darn efficient from the pricing the credit spread reasonably correctly. So how the heck does the bank really make money? And the answer is it's the spread between risk-free and what they get to borrow at. And what we've been seeing for a while now is that spread was pretty decent, right? You were paying deposits 1 basis point, and as Fed funds / SOFR was climbing, and that expansion of spread between what they were borrowing at against what was embedded within the overall lending facility was how in theory they're making money. That's why everybody's like, oh, interest rates are up, like bank stocks are going to start going up, because everybody understood they're going to continue to be able to borrow money well below what they effectively should. And then you had some greedy participants that probably didn't manage that spread risk appropriately. And when all of a sudden people woke up and said, you know what, I don't want to earn 1 basis point anymore, there's other alternatives, then it started creating some problems.
So part of that, maybe like this is a good thing about like the spread and everything, is with SVB thing, and what PJ was referencing, my conversation with Toby earlier was about, it was more the things I learned from SVB was like how many people in their 20s and 30s, understandably, I guess, like always thought that a bank was like, they just kept like their secured funds there. It was like, I don't know, like a gold vault in the ground or something. And they didn't realize like that the banks lent out money. And it was just interesting to see like how much, young people, like the way they understood banking. And then part of that too is, and this come back to what you're just saying, is like, I also got to see how, out here in the Bay Area and Silicon Valley, like they just kept like berating the banks for borrowing short and lending long. And like, that's stupid. And it's like, that's what banks do. Like, you don't understand, like banks or PJ, sorry, you wanted to jump in there.
Well, yeah. So it's when you describe the misconception, one, I think I'll say the misconception sort of spreads more broadly than that. I think generally most people conceive banks as sort of taking in some sort of raw material deposits that they then, manufacture loans with. So in the basic concept of manufacturing or producing something. And that misconception, continues to sort of be propagated, currently, like even with, the fall of SVB and First Republic and these, other regional banks. And whereas, sort of like Zed just mentioned, when he was talking about the way banks make money, and it's all about the spread. And so that's the dynamic that sort of dovetails into what I was saying about, it's about price, not quantity. It's in the fact that when the deposits started leaving like regional banks, the belief is that the regional banks have less raw material from which to manufacture loans with. And, my argument is that, well, no, the deposits are a residual of past lending, not the raw materials that are used to make, new loans or future lending. And so what will happen is if the banks can sort of attract funding, whether it be from a customer deposit, whether it be from interbank lending or, a loan at the discount window, if the bank can attract funding and make a loan at a attractive enough spread, the loan gets made if they have the capital to do so. So with what you were sort of mentioning with that, in a sense, the bank lending is fractional, I think that's correct, but it's sort of a dynamic of terms, whereas every bank has to have a certain amount of lost capital as per their regulators to sort of, backstop their balance sheet. So, simple numbers, if that capital requirement's 10%, a bank with $1 million in capital could have a $10 million balance sheet. Those numbers are rarely that, easy to comprehend. Typically it's tier one capital is 4.3, blah, 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 and it breaks down, and there's an average capital requirement that's probably somewhere around 6%, I think, in a banking system. Today Zed might actually have a better number than me. I mean, it's usually somewhere below 10. But yeah, and when you understand that, I think if you understand that it's about price, not quantity, it's easier for you to sort of look at what drives an actual banking collapse like SVB. And it's really, then you realize that, I would make the argument that every bank, no matter how it's managed, is vulnerable to a SVB style bank run that leads to an eventual collapse if the Fed doesn't backstop you. And by Fed, I just mean the federal government.
Yeah, I mean, ultimately, all banks have essentially a carry trade, which makes them effectively long duration. They have a flattener on, and they can choose to accept that risk, or they can hedge out that risk. And in theory, if they're hedging out that risk, when they potentially have the unlikely event of deposit outflows, they're able to liquidate something on the loan side of the house at a basically market price, because they've removed a lot of the market factors via hedging related to that price. So it's like, if everything was still marked at par and hey, we got some deposit outflows, well, like, go sell some stuff at par. Like, we're all okay. We got the balance continue to be in place. But the issue is when, you start having, your loans not being tradable at par going forward, below par, and you have the compounding effect of, outflows, there's nothing to liquidate. And we saw like the stair step, right? Like SVB, they liquidated things in the fall. They liquidated some more things in January. And it's like they kept tagging what they could sell, close-ish to par. Most of the stuff was like low 90s. But it's like they understood, like, we must, start reducing both sides to try to keep this thing going. And then they ran out of, acceptable things that they could liquidate at a fair price to keep them alive. Like, that's why I'm almost surprised today the Pac West, seemingly people are happy that they were able to liquidate a handful of assets, and everybody's like, for initial commentary was like, this is at better pricing than I would have thought. And you're like, well, like, everybody cherry picked what they sold here, right? Like, you're telling me, like, the 3 billion or the 100 billion they got, and you're like, oh man, that's a decent price. You're like, yeah, that's the best stuff. Like what's remaining might not look so great.
Well, right, and I think you make a good point there, and it sort of elaborates further on the point I was hoping to make and maybe not making well, that it's sort of axiomatic to the banking system, right? That unless a bank holds only assets that it could always sell at par, it's always potentially vulnerable to a bank run. So then what does that mean? I mean, the only asset that you could always sell at par would be settlement balances, it'd just be reserves. So you're not in business if you just have reserves. So as soon as you make a loan, as soon as you have any sort of balance sheet asset that potentially has market risk, whether that risk is credit risk or whether that risk is just duration risk, risk-free assets, quote unquote, still have duration risk. So
go ahead, sorry.
Well, right. So when you actually zoom out, you realize that it's the system sort of designed to where any bank that gets a run potentially just has to shut its door unless there's someone back there with an unlimited supply of liquidity to make sure that the banking system is good on those runs. And that's supposed to be why we have a lender of last resort, to stop bank runs.
Yeah, it's one of those where it's like, it was, call it a year ago. It should have been kind of easy, right? You're paying, we'll call it just zero on deposits, and receiving on we'll call it floating debt, SOFR of like, call it 3%, right? So it's like a bank should have said, all I'm trying to do is lock in that 300 basis points, and that's achievable to do. And the risk that you're hedging there is one thing, but then you also have to do it in liquid items, because if all of a sudden what you're paying for deposits goes from 0 to 300 basis points, your spread's gone, and you should unwind the entire trade ultimately. So it's like, step one, like that's one path of doing it, is just trying to lock in that 300 basis points of your current cost of financing that's below essentially the risk-free rate that you're allowed to earn, plus a spread. What most of them did instead was just, throw a lot of things into their, hold to maturity side of the world, which, becomes problematic when you actually need liquidity.
So there's two questions I have in there. And by the way, because Zed brought up PacWest, I just want to let everybody know we are recording this on May 22nd, 2023. Just to timestamp the PacWest part of the commentary and the SVB part. As we know, it takes forever to find out even, where all the bodies were buried at SVB and what actually went on. Even years later, we might not have a full picture. But part of it, I think my two questions are, from what both of you are saying, is that one, like you're saying, there's a certain amount of fiction within banking, right? Like if we had to run on all banks, like they're all essentially like going to have a problem selling assets at par. So there's always an issue there. But allegedly SVB didn't hedge their interest rate risk. So, but even with hedged interest rate risk, when they still had an issue, maybe selling everything at par, and almost like Zed, what you were saying, the second part of that question is, it comes out, I think, of the analogy of you and I when we had a discussion about like the British LDI kind of things that were going on, is like a lot of those were in funds that weren't liquidating like on a continual basis. And so do you think part of that is like SVB, like, or a bank can get ahead of this? They need to start, liquidating early, or if they see interest rates rising, they need to be really adjusting their balance sheet to accommodate for interest rate rising. Is that fair? So like the two questions are there, like, would hedging interest rate matter other than you just have to hedge your interest rates, and they should have if they didn't? And then two, is it like the continuous nature of it, unless there's a run on all banks, then you're just trying to front run everybody else out of the exits, right?
Yeah, I mean, my view is you should always be hedging 100% of your interest rate risk. It's like that's not how the machine works. The machine works that you're going to borrow well below, the risk-free rate, and you're going to lend at the risk-free rate plus a spread. So why am I taking any sort of curve or duration risk in interest rate? So my argument is you should always be hedging 100% of that, but you're always going to have some assets that you're going to say that, like, okay, like the main risk here is not necessarily interest rates. It's in the spread side of the house, or more like illiquidity premium or something like that. And like, yeah, you're allowed to kind of utilize that, hold the maturity bucket for a portion of those assets that should be in that, vein. But it's like, if you're lending to, a AA institution at SOFR plus, 125 basis points, like that shouldn't be in your hold to maturity bucket. Like that should be nice vanilla. We're locking in a spread. We're hedging out of the interest rate. Let risk move on to the next loan.
PJ, you wanted to jump in on part of that?
Yeah, I mean, I think that's pretty fair. What I would say is, I believe that, I mean, as per the regulations, banks are forced to sort of have a certain amount of, they're only allowed to have a certain amount of liquidity mismatch, right? Um, the regulators learned that during the savings and loans crisis that, like as you said, Jason, if banks, borrow short, lend long, there's a chance that they could have issues being able to provide for, you know, a certain amount of deposits basically being withdrawn from their balance sheet. And the regulators basically impose certain stress tests to make sure that, if rates were to go up, 5% in 12 months, or all sorts of different things within these stress tests to sort of say, okay, you meet the right amount of robustness, I guess, for, you know, these dynamic variables in the system that can sort of change and cause you to have issues, with liquidity. And SVB, I would assume, was in compliance with those regulations. And if they weren't, then the question is, why were the regulators allowing them to do so? I mean, my mentor used to run a small bank here in Florida, and regulators aren't nice guys. They're like IRS, agents. They come in, and if you're not in compliance, they talk about removing management, changing management. If you don't, you have a certain amount of time to comply, or otherwise you go into conservatorship or receivership. Like, when you have FDIC insured deposits, they're pretty strict on these parameters that they impose on banks. Now, SVB had a very small amount of insured deposits, and kind of to add on the question you were asking, there was a lot of things that SVB could have done and chose not to do that could have probably given themselves more of a chance at surviving. Like, you have non-insured deposits. When people want to move that money, there's no contractual obligation that they have to be able to move that money in a day.
I mean, so do you think we're going to see some more, like, it's potential, like if we had more runs on banks, that we would freeze bank accounts like Argentina style?
So if you can't freeze FDIC deposit, those have to be liquid and on demand. But anything that's not insured, yeah, it's a term deposit with the bank. There's a chance that you may not get your money as quickly as you would like to have it. Now, SVB avoided doing so, and they just, made good on those withdrawals as if they were all FDIC insured, but they didn't necessarily have the obligation to do that.
Zed, do you think we should insure all deposits after this?
No.
I know you had personal feelings about SVB. You were texting me while it was going on, but I'm just saying, like, going back to the idea of, like, everybody under 40 had a certain understanding of banks or misunderstanding of banks. So, like, do you think in future for businesses, et cetera, like, we should insure deposits, or you think businesses should have to run a Treasury direct account, or what do you think about that?
Yeah, I think it's, at some level, it's the responsibility of the firm, individual, something along those lines, to assume some of the risk that they're taking themselves rather than putting that onto the public.
PJ, what are your thoughts?
Yeah, I mean, I think so. This is going to be the first place where I think me and Zed are going to be in stark disagreement. And that's because I just don't believe that the liability side of the bank balance sheet is the place to impose market discipline. So, for instance, banks have, like you said, if we start a bank, we're going to start it with a certain amount of capital. That's on the asset side of our balance sheet. Our customer deposits are on the liability side of the balance sheet. It doesn't really serve public purpose to have banks to punish banks by having them sort of try to compete for those liabilities, because at the end of the day, the only people who actually really truly get hurt are the depositors. So if you believe that there's some benefit to having non-insured deposits in the payment system, then it would mean that you believe that there's some benefit that's derived from, you know, individual depositors sort of deciding which banks should attract their deposits. I mean, I would argue that that's just kind of an untenable situation. I mean, to ask mom and pop to sort of analyze SVB's balance sheet and decide whether or not they should deposit money there when they have a, you know, government bank charter where the government's telling you that, hey, these guys meet, you know, all the regulatory requirements, it's, you know, to become a bank, which are pretty stringent.
Yeah, I mean, I think the exact line in the sand can be debated. Like, I'm not, 250 grand might not be the right number, but I think, somebody with $1 billion like should have some responsibility that their stuff is not insured by the rest of us.
Yeah, I mean, it's sort of like it's means testing, right? And I think intuitively, it makes sense for us to have like means testing. Like you said, someone with $1 billion probably doesn't need the public backstopping their deposits. But you could look at it from the other side of the coin too. It's kind of like saying, well, someone with $1 billion shouldn't have access to the public school system for their children. I mean, the point is, if children should be educated, children should be educated. And I don't really think it serves public purpose to have that, to impose that means test. But, it's arguable. And people have
it's just super negatively asymmetric. It's a lot of people supporting the risk of an individual in a pretty aggressive way.
How would you think about that? Like that gray area set of like, let's just say I'm running like an e-com business with 5 to 10 million in turnover, and I'm just using the bank as like just to move that money in and out of whatever. Like the likelihood that I'm going to adjust for their balance sheet or use Treasury Direct or anything for my cash needs is pretty minimal, right? So what do you do in that scenario?
Well, I mean, like, that's just a lot of really lazy CFOs. I mean, like, right. It is beyond easy to set up auto sweeps across everything these days. It's like the negative for bank runs is it's easy to move money really fast. The positive is I can automate this entire thing to have literally like zero risk beyond 250 grand at any single account. And on top of that, which is like, again, lazy CFO, you're like, you were earning 0% in a bank account where you could be earning substantially more in another instrument. So it was like this, irresponsible two ways. Like you were taking this unnecessarily jump risk and you were earning less money than you should have.
Well, so that's where I think I push back a little bit, some more, Zed, because to your point, if what we're basically saying is, if you're a responsible CFO, you'll jump through enough hoops that all of your money is FDIC insured.
For a smaller business that, has a benign treasury department where you're only really carrying like a couple $1,000,000 of cash, like, 10 plus $1,000,000. Yeah, it is your responsibility. It's pretty easy to do.
Well, right.
To like set up auto sweeps.
Yeah. Not to front for PJ, I'm probably going to front run you, right? It's like you're saying, like if you're sweeping and you're algorithmically going below FDIC in multiple banks, why not just insure the whole thing?
Why not just insure the whole thing? Yeah. So what we're saying is, if you
I'm not even necessarily saying between multiple banks. Like you need a minimum liquidity amount of some variety that will sit in 1 to 5, bank accounts at multiple different banks potentially. But like you should be having a treasury function and sweeping that money out of those banks into other type of vehicles that are going to allow you to earn more money on that unencumbered cash for business operations while you're waiting to utilize that for operations. So I'm like, it's almost, it's your responsibility to be acknowledging the jump risk of a potential bank collapse, but it's even more your responsibility to make sure you're earning as much as possible on your cash before it's needed for business operations.
Yeah, I mean, but so what we're describing a situation where if you jump through the right hoops, then you could have unlimited, deposit insurance. It's kind of, I mean, we're basically telling the individual, if you put all the money in one pocket, a fraction of it's insured. If you divide the money amongst all your pockets, then all of it's insured. And I don't really know how it serves public purpose to sort of impose that sort of market discipline on the system. That
I think,
introduces frictions, costs, all sorts of things that don't necessarily add any real benefit.
and I think SPV was a prime example of this because, as you say, it was very de minimis amount of their overall deposits were actually insured, and if people were responsible and were spreading this money around, then it would have been a known quantity that they were on par in comparison to other banks with the amount of their deposits were insured. And as you say, the regulator would have actually been doing their job because they would have seen the amount of risk on their plate for operating that bank. And what really ended up happening here was the regulators lazy because they're just like, well, we got this bank over here, but it's only a handful of billion of FDIC insured deposits. So I don't care about that. On the rung of things that I need to pay attention to, it's towards the bottom because from my seat as a regulator, it's got the least amount of risk in it. It has no FDIC insured deposits. So it's my job is to protect the FDIC. And so I'm going to pay attention to the banks that have a significant amount of FDIC insured deposits. And by happenstance, everybody said, forget it. We're going to change the rules for one or two people. But
yeah, I mean, I think in practice, what you said is true because the Fed has sort of, left the FDIC to sort of handle most bank regulations, where the Fed actually has a regulatory and supervisory role to play in banking as well, which it tends to not do these days as they focus on, modeling interest rate expectations and things like that. So yeah, I would agree that the regulators that were visiting SVB were probably mostly focused on their FDIC insured deposits and found those to be de minimis. But I think that still sort of doesn't explain the dynamic that we saw play out in that situation. Whereas you have a situation where you pass your stress test, so the regulator looks at your situation and says, I mean, you look at this like if this was a fire inspection. The fire inspector shows up and looks at your building and says, all right, everything meets code. This building is stamp safe. Then the fire marshal does some sort of drill, which is like the Fed hiking rates, that causes your building to catch on fire. And then that same fire marshal refuses to hand you a fire extinguisher because you should be responsible for protecting your facility. These banks, if you look at SVB in particular, their assets were all tier one assets. They were treasuries. They were treasury securities. And these assets were deemed to be money good until the Fed took a course of action that made those things trade at a discount to par. You could make the argument that if there was ever a time for the Fed to do QE, it's in a situation where it's raising interest rates so quickly that it's forcing money good assets to become, distressed, for lack of a better term.
Yeah, you can frictionally less hedge 100% of your interest rate risk, both duration curve, everything along those lines. And as a institution that your entire, infrastructure of why you exist is essentially to, as you say, figure out the right price to lend money and then source the funds to go ahead and lend that money and capture that spread. It is, irresponsible for all those institutions to blame movements in interest rates on any of their failures, because that's their responsibility to hedge out the risks associated with operating their business. And again, their business should be focused on capturing a spread. Like it should not be taking duration bets. It should not be taking massive curve bets.
But by definition, if the entire banking system hedges out all its inflation risk, the cost of that hedge is going to be the cost of all the interest risk, which would then be, it would just eat up.
You're just locking in your spread. You're just locking in the spread.
Well, right, but you're locking in that spread by putting that risk upon somebody else. So if the whole system is doing this, then it just becomes the cost of that, of collecting that risk premium over time. You're in essence eliminating the return system wide if all of the risk is hedged out.
You're saying there's no arbitrage condition that if you fully hedged, then like if everybody fully hedged, then there's no spread.
Right.
No, but the spread is the fact that their cost of financing when they're financing via deposits is generally substantially less than the risk-free rate. And that's not necessarily like an arbitrage, but that's the spread. That's the spread you should be locking in.
It's substantially less than the risk-free rate when you introduce duration, right? Like if it's overnight rates in that regard, yeah. So in essence, you're describing a situation where the banking system would just be, long reserve deposits at the Fed earning interest on excess reserves.
Yeah, which the big banks did for a long time because they didn't see a lot of loans that were lovely to be making. So they're like, okay, JP Morgan's going to continue to pay you 1 basis point and just earn their 5 over there.
So,
with zero, they don't even have to bother hedging. Like you said, it's
so wonderful. I think this is good though. So it kind of explains the point that I was making though, whereas when you impose these sorts of conditions, we're describing a situation where we're incentivizing that banks just don't make loans. They just earn interest on excess reserves at the Fed. How does that serve the economy? How does that serve public purpose?
I agree. You'd rather have, that potential capital being pushed through the machine rather than, taxpayers just paying, JP Morgan and not having us get paid as depositors at those institutions. To completely agree with you there. But that's just different than the responsibility of operating a bank where your entire livelihood should be capturing a spread and not taking directional risk and try to do that as many times as you can.
So a bank will model what they think the duration of their liabilities are, and then model what their duration of their funding is, and then through their risk metrics sort of determine where they want to be on that spectrum, whereas the regulator caps how much liquidity mismatch you're allowed to have.
Yeah, absolutely.
What they consider safe, in a safe range. And then you exist within that spectrum. You're describing a situation where there's zero liquidity mismatch and you're fully hedged.
I think it should be a target. Like it's not exactly fully achievable, but that should be a target. And it's so easy to do is the part too. Like I could take. Well,
I think it becomes a fallacy of composition though, right? I could easily hedge when hedging is affordable because others aren't hedging. It's the no arb concept. If everyone's hedging goes to just the price of the risk, and then you're not really hedged.
Yeah, no.
In aggregate, the risk, it's sort of like a musical chair situation, right? In aggregate, you can't get the risk out of the system. You could just transfer the risk from me to you.
Yeah, but again, it's not a risk transfer. It's locking in the spread between what you're paying depositors and what the system is saying the risk-free rate is. Like that is how you're making money.
You're locking that in with what?
I'm going to key rate duration hedge my entire loan portfolio to basically make it look like I only have spot risk. So then I all of a sudden have a portfolio where I'm earning spot risk-free rate plus a spread. We can argue whether there's actually any spread or not, but like I'm earning that and I'm borrowing to support that risk at whatever deposits.
And you're doing that with swaps.
A blend. Like it's going to more depend what my loan portfolio looks like. Like if most things are pegged off a SOFR, I'm probably going to be using more treasury type derivatives just because I don't want to take swap, treasury basis risk.
You don't want basis risk.
Yeah. But like the only times it kind of
who's selling you this hedge?
Oh, it's I can trade $1 billion DV1 like water. Like that's fine. Like
right. I mean, I know it's doable. I'm just as a thought, as we sort of work it out, as you think it through, what I'm trying to ascertain is who are you transferring the risk to when you do this?
But it's also theory and practice, right, PJ? Like I think you're saying too, like in essence, if we all hedge that way, like, right, that's going to be a no arbitrage position. But like that doesn't happen in practice. So like what Zed's saying is like if he was running his own bank, this is how he would hedge that risk. And then then you're saying because everybody's not doing it, therefore it allows that condition to take place.
Yeah. So my only edge is I have a piece of paper, and only a limited amount of people have this piece of paper that allow me to borrow money below what everybody else would pay. Like that's my edge of operating this bank is I get to borrow money from depositors
and where does that edge come from? Where does that edge come from?
That we only approve a handful of banking licenses.
Right. But
they have it all.
And the reason the bank is able, the thing that the banking license gives you is the banking license gives you
And to be clear, this is a bad business. It's like there's only whatever, we're down to like technically like 14,000 like banks, like something like that.
No, we're down to like 4,000 from like 14.
4,000. So yes, they've a decent amount of people have this piece of paper that give them that edge to be able to borrow money less than everybody else. But it's still a really not very good business.
Well, that's gonna give me a great transition in a second. But PJ, I'll let you finish. What were you saying the banking license allows you to do?
So what the banking license allows you to do is enter into a 90-10 or a 95-5 public-private partnership, right? Where if the capital requirement is 5%, that means someone else is putting up that other 95. Otherwise, it's a insolvent system from inception. And that other person who's putting up that 5 is the government. That's the whole point of the FDIC, Insure, the Federal Reserve as a lender of last resort on the side of the banking system. And so what happens is it's not that banks are necessarily borrowing for less than anyone else. It's that banks create their own liability when they lend. So they're issuing their own liability out of thin air. And that's what that charter gives them the right to do. Well, I should rephrase that. The charter gives them the right to do that in a way that we all accept that liability, because we all could issue IOUs out of thin air.
It's just the levers they can pull on to finance that liability they generate is a blend of the different facilities, overnight window, they can issue bonds themselves, or they have this unique one where they can pay depositors no money.
Well, PJ thinks about it. I'll transition us, but so this is where we're headed to. Is actually is a great way where I've kind of pinged you guys with some questions, but we'll flesh it out a little bit more. But before I get to, I got to have an interlude real quick. We go to Treasury Direct and everything. Do you guys do it as well? That website absolutely sucks, and it's only gotten worse. Like as more people are starting to use it.
Yeah, it sucks.
So like we need something better. Like maybe an entrepreneur needs to work on that on the Treasury Direct side. Speaking of entrepreneurs, I mean, coming out of GFC in 2007, 2008, I spent a lot of time looking at banks and thinking about what would it look like to start my own bank. I looked at credit unions, et cetera, of like, how could you like kind of insure all deposits or not take too much risk so you didn't have that bank run, or you treated it almost like we treat gold vaults. And obviously it's exceedingly difficult to do, but like there's two reasons to do it. And but they're competing, right? Like Zed, you're saying like this is a terrible business, but then also like what PJ is talking about too is like you have this capital ratio, so you can, you know, create loans out of whole cloth. So like you have like these two things like that are competing against each other to make it a good business and a bad business. And so like how would you guys go about it? Or would you want, like, because I texted PJ, I was like, you want to start a bank? He was like, hell no. But I was like, like but it does make sense. Like if you think about like Andy Beal and some of these other more like private style banks, is like it gives them almost like infinite capital that all the Buffett acolytes want, right? Like and access to like government on that capital ratio. And PJ's shaking his head already, so maybe he wants to jump in first of like why you would not want to start a bank.
Well, it doesn't give you infinite capital because your capital
Ratio,
you know, you have your capital ratio. So if a bank wants to expand its balance sheet beyond, you know, beyond its capital requirement, you just have to raise more capital.
But I was saying, like you're saying with the public-private partnership is like, let's say that capital reserve's 10%, you know, the government's lending you 9 out of 10 for you to go out and make money off of.
Yes.
Which is a great thing, but then
but the government's also telling you what you're allowed to do to make money.
Right.
So a lot of your best ideas,
fixed costs.
Yeah, a lot of your best ideas, the government just tells you, no, you can't do that.
You'd rather be in insurance. Insurance is much better than banking.
Yeah, insurance is much better. Agreed.
Exactly. No, that's most of like Zed and I's conversations as well. But like part of it though, so there's two things. One, obviously the government at current state, whatever, is never going to allow me Richard Werner style to go out and lend to entrepreneurs at the bank, or like the interest rates are going to be onerous. But like, so let's flip it around though. What if I wanted like just a stable bank that was basically like a vault for my cash, so to speak? And I know you're going to have umbrage with all those words I just used, PJ, but like the idea is like, what if you were just lending, you're just long deposits with the Fed? Like, would that be a way to run a bank that where you can maybe cover the cost in the technological age of running the banks? Or maybe people only need to spend $20 to $50 a month for your banking costs for them to have essentially insured deposits.
So to the degree that you can start a bank, attract lots of customer deposits, pay them a much lower rate than what you're earning on your excess reserves deposit at the Fed, then yeah, you're describing exactly what Zed's been sort of opining about here. That it's a great, you know, they should make a lot, you know, they're going to make a lot of money in that sense. Now, there are circumstances where that's not the case, right? And it's risky. I think I told you the story before, Jason, that, back when Warren Mosler was working at a small regional bank, at the start of his career in the 70s, Congress passed a law that said that the banks had to pay their depositors 5.5% on deposits or lose your bank charter. And at the time, the going rate in money markets was only paying 5%. So to run a bank, you had a net negative carry of 50 basis points. And, it was just kind of a fixed cost of doing the business, as Zed mentioned, whereas you had to figure out a way to overcome that in your, during the course of business. Otherwise, you're just, going to lose 50 basis points. And, at the time, what Warren Mosler did was he took their deposits and deposited it with their competitor and earned the 5.5%. But which is going back to kind of what I was saying before, where, the whole system can't do that, obviously, because that's just a fallacy of composition. But to the degree that you could outcompete someone else and saddle them with your deposits. So yeah, I mean, you could find yourself in a situation where you're not able to have that cheap source of funding.
But part of that, though, Zed, what do you think? Like, I think even people in Silicon Valley have said that they would be willing to pay a cost instead of like making money off deposits, as long as their deposits were insured, if they have millions of dollars in there, when they're running their business treasury account. So like, do you think that's possible to cover the cost of the bank? Like, people may need to pay like $100 a month just for the service, like we do for like a gold vault, right? You're paying for the vault, the security, the technology, and it comes at a cost, not as like you should make money off of it.
Yeah, but I think the number is a lot bigger than that.
More than $100 a month is what you're saying. Yeah. Whatever it is, yeah.
If you have to pay, a 1.5 on your deposits, I think people's tunes will change. This isn't like, cheap SaaS, Netflix subscription stuff.
Well, yeah, right. Because even those are a situation where someone else is paying the cost of that, when that SaaS company is burning investor capital to provide you cheap services.
If you want to be actually insured, it costs a lot of money.
So I want to,
but
go ahead.
I think you make a good point there, though, Jason, to the fact of when we think of risk-free rates as being positive, a lot of the same types who were very upset that, with ZERP and, zero rate policy on, for the risk-free rate, are also a lot of the same types of people who are kind of, I would say, sympathetic to like the hard money view of things. But, if you look at a gold standard situation, I mean, the risk-free rate on gold is negative, as you're sort of mentioning. I mean, there's a negative cost of carry.
But to like almost like it ties also back into Zed's point earlier. Like if somebody has $1 billion in cash, we don't want to insure that. Is like, to me, for the most part, that's what I as an idiot, what I see treasuries in aggregate is just a place to park an enormous amount of capital. So like if China, et cetera, want to put trillions of dollars into some sort of vehicle, then they're going to use U.S. treasuries. Well, I think they should have a negative interest rate. There should be a cost of holding that capital in a safe manner. But maybe I'm an idiot.
I'm somewhat sympathetic to that view.
It's like there's still negative term premium, Jason.
Yeah. So, okay, before I do want to actually, I hate talking about topical things, but I do want to talk about debt ceiling just as a jumping off point for a conversation. But before we get there, almost like a little speed round.
Jason, yeah. I really thought you were going to go with Jimmy freaking Butler. Like that is the important
I haven't been
thing
watching.
Of the day.
Unfortunately, yeah. You're
talking
about Jimmy Buckets is a guy.
Jimmy Buckets,
like that's the topic of du jour, not debt ceiling.
PJ, are you a Heat fan or no?
I am.
Well, that's and we were talking about the Bright Line before we got on. You could take the Bright Line down the stadium. There's many times I've been on the Bright Line where people are going. You can walk right from the Bright Line station in Miami right to it used to be American Airlines Arena, then FTX, and is that going to change?
Anyway, I think that the FTX sign might have been taken down already.
Yeah, Zed, I appreciate you trying to transition us away, but I'm going to keep coming back to it. But in a speed round, though, before we get there, is like I'm just curious, what do your guys' takes? Like, because people are talking about again, does an inverted yield curve matter? Is that important at all? This is just kind of like a speed round, like kind of question. Or, yes. And I should say, okay, you say yes, but let me start with, correct me if I'm wrong, the original paper was the 90-day and the 10-year, but people always quote like the 2 and the 10 or the 2 and the 5, and like people use all sorts of different instruments to now quote it. But isn't it technically in the paper, it was the 90-day and the 10-year? And most people don't try to replicate the 90-day.
Does the yield curve matter? Does the inverted curve matter for what? Would be my question.
Well, one, I have a problem with anybody goes, well, it predicts a recession, in the coming years. Like it's almost like saying transitory or something. It's like, you're not giving me a date. Like, does this really matter? And then my point is pre-1980, like the yield curve didn't predict anything. Like it was less statistically significant. So is this time different? Like how long does this keep going on? And if everybody starts attenuating their portfolios to an inverted yield curve, does it change in real time?
I was just saying, the only reason it matters is there's a lot of product that's been built that essentially is a carry trade, right? And so it's like, okay, are they overnight funding? Is it 3 months? Is it 2 years? Who the heck knows? Like, what's the most important point on the front end? But like, that's why it matters. Is people are taking leverage by borrowing short to buy, risk assets that obviously have duration to them. And what matters more is like the move, right? That's like going from steep to flat to inverted. And then when do people have to refinance the carry portion of that position? So that's why it matters. Like in my view, is it's just a financing thing. And like when they have to reset financing, does it make sense to continue to hold all those long duration risk assets at that current cost of financing and maintain that carry trade position or not?
So you think that axiomatically would lead to a recession, the unwinding of those carry trades?
No, I think it's probably more, asset price based than necessarily, quote unquote real economy. And, if it doesn't just, the quote unquote wealth effect, if things don't tank too much, then it's not automatic. It's going to be a recession.
To me, it's sort of, and I think what you're alluding to is, does it matter as a recession indicator. Is that what you're asking, Jason?
Yeah, that's probably fair. It's more like one is the mechanics that Zed was just talking about, but me it's more like financial media just using this one, like they just love when this happens because then they all go crazy with their bearish rage on news cycles, and then just say that it's a recession's imminent, but you just don't know when. So that's like unhelpful for a trader.
Right. So I mean, what I would say is the yield curve is a recession indicator in the sense that it tells you that the market is forecasting a recession. And so it's all right, the market believes there's going to be a recession. Okay. Do with that what you will.
Yeah. Well, it'd be interesting to see if it works in a rising rates environment too. Like I was saying, all the research on it's only since 1980. Like they time windowed like how often it's been predictive. So I don't know.
We'll see.
Go to PJ.
No, I was gonna say I often say that the yield curve is predicted 17 of the last 4 recessions.
Just like Robert Kiyosaki and then what's Dr. Doom? Yeah, sorry.
What were you and all those guys.
I'm more just like the shift in the yield curve has a potential of creating forced selling because it makes it less interesting to borrow money to buy things. And I think potentially decent amount of that carry trade style of investment has actually been done more so on the private side rather than, the public side of tradable assets over the last 10 years. And so it probably is mattering. They just have a longer leash than forced liquidation of, I don't know, so some commingled product that's all trading, listed instruments that like, okay, it's a forced unwind, right? It's a little bit different on that sense.
The two go hand in hand too, right? Where I think you're right. The yield curve can cause some forced selling, but oftentimes it's forced selling that causes the yield curve to invert.
So thinking about this debt ceiling thing, like I said, this stuff drives me kind of crazy. I don't really enjoy talking about it, so to speak, but there's been some interesting mechanics underneath the hood, at least. In general, I think the debt ceiling stuff to me is like the world is full of sound and fury and the end signifying nothing. They typically raise the debt ceiling. So there's a lot of probably just political posturing and kabuki theater, except that I'm sure you guys deal with this too as people that trade derivatives, with our FCMs and et cetera. I've been getting calls and emails saying like even rolling T-bills, 90-day T-bills, they're nervous about, the duration, even of your 90-day T-bills. Like when is that window going to come into effect with what's going on? What if is a government shutdown? So you're dealing with that side, which is kind of crazy. The other one is, you see people that wanted to buy like CDS against like the US like dollar, like government and everything. Like you can get paid in euros. And if it collapses, like, how do you think you're going to get paid out? Like, how is that going to work? The other piece to that though is Zed, you and I were texting a few weeks ago how like commercial real estate lending was basically drying up. And I would assume part of that's like, they just want to wait and see what's going to happen with like the debt ceiling. But I really don't have a specific question other than just kind of laying those things out. So whichever one you wants to like jump in first to have any thoughts or feelings about debt ceiling or if this stuff matters. Like Zed, I know you and I've been texting about it quite a bit about like, a lot of credit drying up where people are just, it seems like in a wait and see mode. Is that fair?
I don't know. I think the market is not really thinking there's a lot of risk here. Like I would say there's not a dramatic amount of, nothing. The prices aren't telling me that people are very worried about it.
Yeah, but
it's more.
There's not a ton being discounted. Yeah. Debt ceiling. Interesting. So whenever I have discussions about the debt ceiling with anyone, one of the things I say is that I agree with your point where typically the debt ceiling is a non-issue. It typically always gets raised. The thing that makes the debt ceiling somewhat interesting to me, though, is the fact that it's a situation where the politicians sort of play chicken with this deadline, and it's a situation where I think it's like you're throwing, you're playing with like water balloons or what you think are water balloons, but it turns out it's actually like a mini nuke. And I say that because like I don't think too many people actually realize how bad it really would be to actually smack that debt limit and what that looks like. I think most people sort of model it with what we saw with the government shutdowns.
Mm-hmm.
But it's very different. It's a much more dynamic situation than the government shutdowns. Like with the government shutdowns, you basically furlough workers and you defer payments, and you kind of basically use some accounting tricks to sort of avoid what would be termed a technical default. Actually hitting the debt ceiling just creates this pro-cyclical, like, race to the bottom, where the government is forced to immediately cut spending, which then means less income in the economy, which then means less tax receipts, which then means the government has to cut spending further, less income, less tax receipts. I mean, you could get like a 50% reduction in GDP in 2 weeks.
Well, what I think is most interesting, because the question is, does it cause everybody to dig in, to their side of the trenches harder or not? And what I'm, getting to is there's a ton of money that comes in on June 15th. And so even if you run out June 5th, it's like everybody knows, we're back open in 10 days. And so does having that, knowledge base that like, oh yeah, like we went over the line, but like we're all the way back in like 10 days, like cause people to dig in further and not get things resolved because everybody views it as, it's just like a silly bridge. Like they can, technically not pay people and then pay them on the 15th and be like, don't worry about it. And so I don't know what side of it it's on, but
yeah, I think there's a lot of that kind of stuff that sort of leads to it. I mean, I just think that if we actually failed to raise the debt limit, I think the politicians would quickly realize, to me, it's sort of like the bombing of Pearl Harbor, where you immediately realize, okay, maybe this was way worse than I thought it would be.
Yeah, I mean, like the question is, if you get to, again, just make up a date, but you get to like June 5th, and you're like, technically we're there, and Yellen can basically say we're gonna do some things to last 10 more days, or she can say we're not going to do those things to last 10 more days. And which one is a more politically digestible decision? Like, my whole thing is I do think the 15th, because everybody now acknowledges the amount of tax receipts that come in on the 15th, that like, unless one side really caves from extreme fear, that we're probably going to push through that event because everybody doesn't view it as a long-term problem. It's like, yeah, it's a week of silliness, and then we got money again.
There's a couple questions around there, but I'll take a quick side tangent because PJ brought up Pearl Harbor and everything. I was listening actually to Founders Podcast this morning on my walk, and it was about Saul Price, the founder of Costco. And after he was living in San Diego as a lawyer, and after Pearl Harbor, he was working as a lawyer during the day and then working for like the Defense Department at the night. But what I didn't know is they post Pearl Harbor, they blacked out like San Diego and a lot of West Coast cities. So at night, he's like, how do you get around with no lights? You got to drive. Like, how do you navigate that? And I just think like how people now think they make so many sacrifices. And it's just like they blacked out the entire city for months on end. And like you're trying to like get to these night jobs to help out the government. That's just like an insane proposition when you think about even navigating San Diego. But that's neither here nor there. But like so we're talking about debt ceiling though. Like Zed, how do you think about like what is the appropriate amount of debt for the US? Like, is this a Malthusian number? Like as a global hegemon, like, is there a number? Like everybody likes to argue about like it's too much or, it's not. Like, how do you even know what's too much? Like how do you think about it? How do you conceptualize it?
Yeah, I mean, I don't think there's a number in the sand or anything about like what's too much. I personally think the problem is future liabilities, not necessarily the ones that we've already got on the books, but all the promises we've made with various programs into the future. Like exactly, like a blend of entitlements and other things that we've essentially already committed to providing into the future, and that's probably what causes problems at some point. I don't know when. Like, it's like the number, who the heck knows? But it's just running out of the ability to actually provide those services. Like, forget necessarily the money, like just having enough human capital along with money capital to provide all those services that we promised. Like it seems like we're going to have some sort of impasse. I don't know if that's 5 years, 10 years, 40 years, but like that's what worries me more than necessarily a specific number of the amount of debt that we got.
PJ, what do you how do you think about like what's the appropriate like percentage of debt to GDP or any of that stuff? Do you think it even matters?
Yeah, I don't think in the terms of debt to GDP matters because, I think I've said to you before that, economics, particularly macroeconomics, is like the art or the science of confusing stocks with flows. Whereas, the debt stock is the debt is a stock and GDP is a flow. So the two don't really have that much, importance in sort of relating the two numbers together. What I do think, and I'm in agreement with Zed, whereas I think the bigger concern is productive capacity, whether or not we have the ability to provide the necessary goods and services that our entitlements sort of imply are necessary. And I think the thing that's interesting about that is most of the debt related concerns, I think, actually tend to make that fear, or make me fear that we're going to have a worse situation that way. Because what happens is we end up not investing and then making the necessary capital investments today that would improve our productive capacity to be able to then, provide those necessary goods and services in the future. Which is, investing in our infrastructure, investing in education, and doing all these sorts of things that are going to make us basically more productive. Because, I think that at the end of the day, it's the real resources that matter, not the entries on the Fed's balance sheet.
Yeah, forces things towards payments rather than investment.
Exactly. Well, yeah, I mean, and we do that in so many different places, right? Like, so if you see your children as an expense, then you, instead of an investment, the way you interact with, allocating resources towards them is going to be very different, right? I mean, if you see children as an investment, then you're going to want to give them, good education, you're going to want to allocate lots of resources towards that investment. If this is an expense, you're going to want to minimize costs. So, you get two very different outcomes depending on, just that simple framing.
So, yeah. And the amount of debt you have makes those decisions harder rather than easier, without a doubt.
Well, two questions around that. One is, as a trader, do you like these like debt ceiling negotiations, everything, because it gives you some more maybe volatility in the market, or volatility compresses while we wait to see what happens? Or would you rather you just can't wait for this to kind of pass and get back to your regular trading schedule? Maybe we'll start with Zed on that.
I very much dislike having any either fiscal or monetary stuff involved in my day-to-day trading activities.
What do you think?
I have no edge. I just have no edge. Like, I have no idea what they're like actually going to do, and whatever they do I think, how does it matter? Like, and what is that? If I knew exactly what they were going to do, do I think markets are going to move? My conviction on that is pretty darn low too. So it's like, I prefer not having them involved.
PJ, how do you think about the trading around it?
Yeah, I mean, I tend to agree wholeheartedly. Like, I think there's very little edge in deciding whether or not, Congress is going to pull the right lever in time to avoid, these kinds of things. And it's one of those situations where even if you get the trade right, when they do the wrong thing, you got bigger problems to worry about typically anyways. So,
well, like you said, like figuring out the cascade of consequences, even if you knew exactly what was going to happen with perfect, foresight, is like positioning paradox, all those things happen to usually
Yeah.
put the trade against you anyway. Like
Positioning,
it's
counterparty risk. Yeah, I might have
yeah.
the right trade on with the wrong counterparty who they can't pay me anyways. So who cares?
Or everybody's pre-positioned for that move or whatever, or not positioned, so it just violently lurches the other way. One of the things though,
Yeah, or like middle ones will say for like vol markets, where you're like, okay, right now it's pricing in a benign amount of risk over the next handful of weeks, and you're like, oh, they decided the June 15th date is all that matters, so they're going to do a 2 week bridge. You're like, geez, like they didn't actually solve anything, but like it killed off my trade because I was focused on the last like next 3 weeks. You're like, that's not very fun.
yeah. But do you
Yeah.
also that are the kind of similar analogies is like was it Q4 of 2020, the Trump election, everything. There was like that kink in the vol curve anyway. So like even though you want to maybe be long, like you're paying so much for it, like it doesn't really matter because of the event risk. And then you and I talked about like in Q4 of this just last year, is everything was around like FOMC meetings. It was just like 1 day intraday vol. So it's like it's very difficult to trade around like these event horizons, right? Is that a fair way to look at it?
Yeah, I tend to attempt to avoid having. I try to have risk lower on those days because, again, general like markets are tending to price something in, and it's something that I don't have any edge in.
PJ, do you have edge? That you want to talk about publicly around these events?
No.
So this is
No.
this will this will transition us, I think, in an interesting way for the last kind of topic of conversation. So speaking of trading, figuring out what's going on in the world and trying to be predictive of kind of macro events. Recently, Hugh Hendry and Russell Clark were on like a podcast, kind of like, they're looking at the same things, but they get two completely different conclusions on what the trade is, right? And right now, Hugh Hendry, at this date and time, and I don't want to speak for him, is basically long TLT. He thinks everybody else is positioned on the other side. He thinks that like long TLT is going to be the move, and it's already, gotten beaten up too much. So he said he thinks everybody's missing that. On the flip side, Russell Clark says now we're about to go through a secular kind of inflationary period. So Russell Clark's trade is like short TLT, long gold. So like they're looking at similar things and drawing like the exact opposite conclusions. And so everybody's now talking about like structural or cyclical inflation, right? Like, are we, is this a paradigm shift? I'm just curious to like how you guys think about those things playing out, like how you position your book. Like, does it matter? And like, I'm not sure if anybody's right. Like, how can we know if it's transitory or secular, like while we're trading it, right? Like you only know in hindsight. Like, how could you possibly know that? And maybe, I don't know who wants to jump on that grenade first.
Go for it, PJ.
Well, yeah, I mean, yeah, I don't know how you know. I don't believe I ever know anything about the markets. It's always about probabilities for me. But I mean, I'm sympathetic to the argument that we may be seeing. Jason's doing this to me on purpose. He knows I'm hesitant to use the term inflation when talking about these sorts of things. So I think I'm sympathetic to the idea that we're likely in an environment with more price pressures than we've been accustomed to over the last 30 years. Um, I think some of that stuff is just sort of by definition, and it's nothing particularly insightful, but I think everyone sort of has been talking about these things like, reshoring of supply chains and, adding redundancies. So we're generally moving from a very specialized, very efficient, globalized economy to one that's going to be more regional. So there's going to be a lot of global redundancies, which just means things are probably just going to cost more. And also we are going into an environment where we're coming out of an environment where the Fed was in essence eating lots of vol, and a lot of that vol sort of needs to get priced back in the markets, which is another friction, another form of inefficiency that just sort of makes capital allocation less, or it makes it harder to sort of allocate capital and feel comfortable about your risk. So then everything you have to build in more of a margin for error. So that means the cost of capital goes up, all these kinds of things. So, all these things are just inputted into the price level. And then by definition, higher rates, if you look at forward pricing channels, higher rates also feeds into higher prices. If you're a home builder, you're going to pay more money on your debt. So you're going to have to charge a little bit more for your homes, so on and so on and so forth. So I'm very sympathetic to that view. The only reason why I'm a bit cautious about just putting on a bunch of, secular inflation type bets is that you kind of never know what you don't know in that regard. Like oftentimes deflationary pressures come from something that no one really anticipated. Whether it be some sort of innovation, whether it's going to be AI, whether it's going to be, additive manufacturing, who knows? So I don't think it's necessarily the type of thing that I don't think it's the type of thing that there's going to be a ton of edge in trying to monetize. Everyone's aware of it. Everyone has a flavor of their opinion of it. And it's, I don't see any clear asymmetric bets that I think are going to, definitely pay out.
I think that's Hugh Hendry's argument about his long TLT trade is positioning. He thinks that everybody's positions on the other side of that trade.
Yeah, well, if that's true, then I'd be sympathetic with that view. I definitely like to be on the other side of the boat.
Yeah. So
than the crowd.
There's a couple of things. One, I'm glad you brought up like term structure because we all deal with commodities, and I've never understood that. It's like as soon as you raise rates, you're embedding that in the term structure of commodities. So you're just generally like increasing prices like automatically, and anybody that's trying to hedge commodity exposure or even end users. But Zed, I'll say it maybe another way is like, how do you think about like PJ was kind of hinting at there, whether we want to call it, nearshoring, friendshoring, I heard it called recently, is like those likely create like regional inflationary dynamics. And does labor ever get its hands around it having any ability to have some pricing power? And then when you have contributing factors, let's say of like China coming back online, that's allegedly disinflationary, or like GPT and LLMs and AI coming online, that's allegedly disinflationary. Like, how do you even like sort through those forces?
As a kick it off, I agree with PJ that where things are currently priced doesn't seem like there's significant amount of edge on either side of that position. So it's like, cool, we can pontificate about what we think 10 years from now is going to look like, and we'll never remember that in 2033. But like in terms of running a portfolio, it's like we're kind of down the middle of the field, like in terms of likely outcomes. So it's like I'm not really on my radar for what we should care about day to day in terms of running the portfolio. I'd say one little different take maybe on like inflation. And if you just said super benign, you're like, okay, there's like fixed costs and variable costs, and like what's in what bucket and how much in what bucket, who the heck knows? But like variable costs, like as you said, like labor and onshoring and all that kind of stuff that's probably a driving component there. But like most of your fixed costs are likely driven by things that are like quasi hard asset based. And I think a lot of the inflation that we've experienced in the last, call it 2.5 years, is we didn't allow, might not be the right word, but we didn't allow a reset in fixed costs from a snap recession, whatever the heck you want to call it, happened, the first 2 quarters of 2022. And so we've had fixed costs be maintained higher probably than they likely potentially should have been, which has provided that floor to like what we've seen over the last handful of years. And so I think the real question for like, inflation, deflation, all that kind of stuff is, do we actually get a fixed cost reset? And the most likely driver of a fixed cost reset would be a decent like default cycle. So you're like just the super vanilla, you're like, okay, I'm running a business, I'm paying rent. Like I didn't have to, sadly, I didn't get a big bonus on rents falling over the last interchange because nobody defaulted on their building that they were leasing to me. But maybe next time that's different. You could actually get that fixed cost reset to some event, and that would be deflationary if that actually takes place. But
that's actually an interesting insight, and I would agree with that.
You're saying like
Um,
a debt deflationary spiral, basically. Like we have to actually
It's not even
like
like
everybody has to
necessarily
take
like
the
a
markdowns.
spiral. It's just like, yeah, like if
it
all of
could
a
be
sudden,
a one-off reset, right? It doesn't have to be
yeah,
a spiral. It could, you know.
like I have to earn X amount in cash flows if I'm carrying an asset at $100 million. If all of a sudden the asset's only worth $50 million, the amount of cash flows I need to support that asset are very, very different. Thus, the people that are paying me those cash flows to support that 50 million valuation are gonna receive some of that benefit.
Well,
Right.
as PJ said, a one-time reset, or you're saying the write downs, like it actually pairs nicely to my final question, almost related to that. Is like, is that are we talking semantics, or like I just can't see, and I'm just not creative enough, that like all of this humans being humans leads to some sort of jubilee. Now, if you call that a one-time reset to take the write down or whatever, that would be a form of jubilee to me. But like humans being humans, our optimism and our debt load and our debt burden is just, it seemed like it always increases until we have some sort of reset. Am I completely wrong on that? Or like, is there a way
I
to
mean,
do it?
I mean, you know, I'm a big distress guy, like, and I think that's healthy to have, that reset take place because the survivors on the back end, again, are gonna have better operating businesses because they're going to be able to participate in the newly created environment post that reset. We definitely are fighting any reset hard. I think governments and humanity always fights a reset really hard. And so, it's going to be, some one-off
Well,
event that
so
probably has us wander down that path, but to predict it, I don't think there's a way to do that.
well, yeah, I mean, I think it's interesting because those sort of debt jubilees typically happen in situations where there was a monarch who had absolute power and would sort of, based on their understanding of the system, decide that, okay, the debt burden's too high, it's causing stagnation, so we're going to reset the debts. So, the rentier would scream and moan, but it didn't matter. The king said, so the king said. I mean, the king gave you your title anyway, so you know you're going to collect less economic rents moving forward post the reset. I think in this environment, with the amount of political capture that capital has now, I would agree with Zed that I think we would fight any sort of a reset. I mean, if you look at what's going on right now, you could frame it in a way, and maybe it's unfair, but the Fed is fighting inflation by raising rates rapidly, which causes the Treasury to pay higher interest rate returns on its debt, on outstanding debt, which means that the Fed policy basically means more money for those who have money in proportion to how much they have. Um, so it's, we had this situation where, you could blame the Fed for, causing it. The narrative was that the Fed caused too much income inequality by keeping rates at zero. Now the Fed is also causing income inequality by causing there to be a higher government transfer payment from, the government sector to those who already have money in proportion to how much they have. So we're sort of in this situation where it seems to always end up on the capital side of the equation, um, as opposed to the labor side of things. And, I don't know, sometimes when you don't get that debt jubilee, sometimes it ends in revolution, which I don't think we want to see.
Which is, it's just another form of jubilee eventually too.
Right.
Like, that's what I think about often. Zed, what are your thoughts on like the raising of rates essentially becomes universal basic income for savers? Like, do you have any thoughts on that? Like, or pushback on?
Well, I mean, up until 2 months ago, like, they weren't receiving any of that.
Right.
So, there's a lot of moving pieces associated with, higher rates resulting in folks actually getting distributions on their savings.
Well,
again, if you're still at JP Morgan, you can anything.
well,
So,
no, but by that I mean specifically those who own sovereign debt.
Right. No, we're walking up the ladder. Like this isn't your, $500,000 retiree. Like,
so you're absolutely right. If you have money deposited with JP Morgan, you're not getting that, but JP Morgan sure is.
Well, and then PJ, you were saying, you reminded me of the monarchies were usually the ones that preempted, like that created the jubilees. Is allegedly that's why the Rothschilds like even created bonds or government bonds, because they got tired of dealing with the whims of monarchs, and then they also wanted to release some of that money from the landed gentry. So they allegedly created government bonds to trade. I don't know how true that is, but that's one of the historical reference points I always find is interesting. I want to thank you both for coming on to just have a chat. I look for. I actually had like I said, I didn't have any questions, but I actually have a bunch more, so we could always set it up for future conversations to be had. But I look forward to Zed seeing you tomorrow at EQ Derivatives Global in Las Vegas, and then next week I'll actually be seeing PJ at the Collective in Lake Tahoe at the Edgewood Resort. So I'll get to see you both in person soon, which is always exciting for me. But at the
I'm jealous. I would definitely take Tahoe over Vegas.
What are you talking about? That's crazy talk, Zed. Let's plug away again, Zed. Where can people find you?
Best visit us, convexitas.com, and you can see myself and Devin Anderson and Brian Wysocki on LinkedIn for the Convexitas group.
PJ?
PJ Pierre on LinkedIn and at Tatiana Pierre on Twitter.
Thanks, gentlemen. Appreciate it.
This podcast is provided for informational purposes only and should not be relied upon as legal, business, investment, or tax advice. All opinions expressed by podcast participants are solely their own opinions and do not necessarily reflect the opinions of Mutiny Fund, their affiliates, or companies featured. Due to industry regulations, participants on this podcast are instructed to not make specific trade recommendations nor reference past or potential profits. Listeners are reminded that managed futures, commodity trading, forex trading, and other alternative investments are complex and carry a risk of substantial losses. As such, they're not suitable for all investors, and you should not rely on any of the information as a substitute for the exercise of your own skill and judgment in making a decision on the appropriateness of such investments. Visit mutinyfund.com/disclaimer for more information.